Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to look at 5 different companies that are in the growth sector. These are companies that are very exciting. These are companies that everyone's talking about. These are companies that possibly, every time they report their earnings, they're talking about AI and how they're going to change the world and everything else. So I want to give you my opinion on these 5 different companies. It doesn't mean that if I'm bullish on some of these companies, you should go away and buy it. Honestly, you just need to do your research and make sure you understand exactly what you're investing in, because these are the type of companies I will definitely warn you to be, to be 100,000% sure you basically you want to buy them, because otherwise you could easily lose a lot of money. Okay, and I just want you to be careful with these type of companies. So I'm going to go over the 5 companies, and then obviously I'm going to give you my view of what I will do if I own them already, and if I don't own them, would I be owning them in the next few months, weeks, years to come, inshallah. So let's get started. I don't want to make this video any longer than it needs to be. But one thing I want to mention very quickly is, if you haven't joined us on the Discord and in the basically Patreon account, please do so, because you can actually see any buys and sells that I normally make. You can get all the trackers, okay, for the US versions, UK versions, ETF trackers, and then you obviously have the private Discord access to that. So for about £5 or whatever it is, you should be able to get all of that, inshallah, and it definitely helps the channel. Right, so what we're looking for is the 3 things I want to focus on is the 3 yellow bits here, the total return for the last 10 years, because we want to see if these companies have done really well, okay, and then we also want to see what the earnings will look like next year. So what are the analysts saying? Are they going to grow their earnings next year and year after that? At the same time, we also need to look at the next 5 years, every single year, next 5 years. We'll also look at where they are right now in terms of valuation. Are they really expensive? Are they cheap? And then we will see the price, okay? And obviously, we also have the Morningstar ratings, which tells us if the company has a wide economic moat. Basically, that means they have a competitive advantage over their competitors. You've got the price, you've got the EPS, the earnings per share. Some of these companies might not have any earnings, so you have to be careful. Then that means if they don't have any earnings, they don't have basically the EPAR, so that means they don't have a PE at all. And the price to earnings to growth is actually, or the PEG ratio is actually quite good one to use for high growth companies. Anything above basically 1 is something that we just need to be careful. Between 1 and 2 is okay, and anything above that obviously can be very, very expensive. You have to be careful. Price to sales, again, was the same as the price to earnings or the PEG ratio. We want to see anything between 1 and anything below 1 is absolutely beautiful. 1 and 2 is okay. Above 2, then you're actually playing with fire. Okay, then profit margin, return on equity, and current ratio. We want to see current ratio side of things. We want to see if basically company has enough cash to pay off any basic current liabilities, inshallah. And then obviously free cash flow would definitely help. Any company that doesn't have a free cash flow, I normally try to run away from them, because especially in this kind of high interest basically situation that we're in, you don't want the company to go to the bank and get interest, and then obviously they will have to pay off that debt. First company we're looking at, no surprise, is Nvidia. Nvidia is one of those companies that are right now very, very hot, because they are up quite a bit, basically a year to date 91% up. That's ridiculously crazy. So if you bought this right January the 3rd or whatever it was, right, you would be up right now 91%. At that point, it was trading $143 per share. Right now, $273 per share. So this company has done absolutely amazing. Basically for 1 year, 38%, and then 5 years, it's 387. 10 years is even better. Okay, so this is one of those high growth companies, definitely. So it has a wide economic moat, $273 per share. EPS is $1.74. PE right now, okay, it's the current PE of 157. It has a basically, let's have a look. The forward PE is slightly better, okay, it's 60. Now it has a PEG ratio of 3.38, so that tells us expensive. Price to sales ratio of 25. We said about 1 is basically okay-ish, right? Profit margin 16, return on equity 18%. Current ratio is above 1, which is good. Free cash flow $3.81 billion. Total return in the last 5 years. So when we say total return, we're talking about price appreciation and dividends, all of that, all up together. Basically, you would have got 55%. Next year, 33%, and then 21% after that. And for this reason, okay, the price, basically the stock is right now 36% premium according to Morningstar, and I do agree with them. 200 should be the way it should be right now, but it has passed that long time ago. So let's have, in terms of earnings side of things, let's look at the estimates. Let's look at the annualized earnings. Okay, so this year, so next year, they expected 41 people, analysts, have looked at this company, and as you can see here, 30 billion, so that's about 11% growth. The following year, okay, 24%, 23%, okay, and then 26%. I think up to the 4, that's what we can do that, okay. But yeah, so it's growing massively, and that's probably one of the reasons that basically people are willing to pay for all that price, okay. Next company we look at is Tesla. Tesla obviously doesn't need any introduction. Okay, let's have a quick look at how much it's gone up this year, or if it's a flat or it's down. So as you can see here, a year to date is actually 50% up. So it was about $108 in January. Remember, January was when it was actually quite down. I think I don't think it went below 100, but it was heading that direction at one point. And now, if you bought it then, okay, when it was $108 per share, right now you would have made about 50% of all your money. Okay, now it has a narrow economic mode, $161 per share. EPS is $3.40. PE is actually not bad, 47, considering this how crazy this company is. And the forward PE is about around the same as well. Is nothing huge there. Okay, PEG ratio 1.6, which is not bad at all. Price to sales 6.21. Profit margin 13%. Return on equity is good. Current ratio is above 1. Free cash flow $5.78 billion. 53%. Last year it returned 55% in the last 10 years. And then next year, it basically it's expecting about 40% almost, then 10% every year. So this year, okay, so this 2023, they're expecting obviously 40%, and then after that about 11% every single year for the next 5 years. 25% discount right now according to Morningstar, and that's 240. Basically, it should be about $215 per share. Now, if we look at the earnings for going forward, okay, if we look at the estimates, let's see what they think in terms of revenue. That is, by the way, so that's 100 billion. So this is December 2023. They're expecting the earnings to grow about 22%, the revenue to grow 22%. So we'll just look up to here, maybe. Okay, there's a lot of analysts looking at this company, right? So 30%, 24%, 13%, 21%. So it's actually heading the right direction. And at the same time, when it comes to the earnings, for example, the EPS side of things, okay, it's also not bad. 46%, 40%, 8%. Okay, that's down 2026. But there's only 7 analysts looking at that. So there are lots going to happen in between. But let's say, for example, on average, this company will be retaining about 20-30%, which is absolutely huge. So that's the second company. The third company is Palo Alto Networks. Okay, and this is one of the cybersecurity companies, and I've talked about this before. It has wide economic mode, 182. Okay, and it's actually gone up quite a bit as well since we've spoken about this company. I can't remember exactly when we did that video, but let's have a look at the stock. So let's go to first summary and then look at the year to date. So 31% up from basically since the beginning of the year, so which is actually quite good. So let's have a look at the 6 months. Okay, 1 year. Okay, so it's down for the year basically, because obviously it's gone up so much at one point, it has to come down, right? 5 years, we're looking at about 183% return, and then 10 years, we're looking at about 900% return. Forward PE of 46. Okay, so which is not bad. Right now, the stock doesn't have a 46 is basically the forward. Okay, because obviously the EPS is actually negative right now. Price to earnings ratio is actually 1.36, which is not bad at all, but price to sales is almost 10. Profit margin is not there at the moment. Return on equity is not there at the moment. Current ratio is below 1, so that could potentially be a problem, but they have a free cash flow of 2.7 billion, which is absolutely fine. They've returned to basically about 26% in the last 10 years, and then next year they're expecting about 16% growth, and then after that, according to this Yahoo Finance, is actually saying 2,500 and basically 5% return every single year after that, which I don't believe. Okay, so let's go to earnings here, and then we can see the estimates what they look like. So this year, but it's 2023 of June this year, when they actually July this year is actually when they closed the year. They're expecting about almost 60% growth, then about 16%, 17%, 35%, 22%. So up until whatever. So maybe we'll take the first three. Revenue is exactly the same. We'll take those first three because we've got a lot of analysts looking at the first next 3 years. 25%, 21%, 19%. So that's actually not bad at all. Okay, so whatever this is, I wouldn't worry too much about it. But if the fact is, if the company can grow every single year, basically their revenue about 25%, 26%, that's a high growth company. That's a really good company, and 7% discounted right now. Let's go back to Yahoo Finance, Seeking Alpha, sorry, and see what the ratings are for this company. So according to the Seeking Alpha analyst, is actually a buy right now, and same goes for the Wall Street, but their actual software thing is actually almost a buy. Okay, almost a buy as well. So another great company. CrowdStrike is the next one that we need to look at. Again, another cybersecurity company. It has a narrow economic mode, $121 per share right now. EPS is not there yet. PE is obviously, this is a forward PE that I've actually copied over from Seeking Alpha. Okay, and look at this stock right now, year to date. It's about 17% actually down, 17% up. Let's call it 18%, which is not actually bad at all. I thought it would be a lot worse. But in the last 3 years, I think it's been around since 2019. So it's down right now, 41% in the last, basically this year. And the last 5 years, only obviously started in 2019, I think, or 2020. As you can see here, okay, you would be, what's going on here? Oh, it doesn't give us because obviously the 5 years doesn't exist or whatever. But forward PE, we're looking at about 54. Let's have a look at the rest of the information, and then we'll come back to Seeking Alpha. So as you can see here, 1.74 is not actually bad at all for this company, and price to sales of 13.5, that's quite big. Okay, profit margin, return on equity obviously not there. Current ratio is above 1, which is good. They do have some free cash flow, and then the 3-year total return of 3 years basically is about 20%. Next year they're expecting the earnings to grow about 20%. After that, 38% every single year. 19% discount according to Morningstar. $156 per share is where it should be. Let's have a look at now the ratings, okay, for this company. So according to their software, which is never gives anything a buy, it looks like it's actually a buy, almost a strong buy, and then a buy here and a strong buy here. So that's very, very interesting. We've got 28 analysts looking at this company. Sorry, that's saying it's a strong buy. 11 is saying a buy, and so on. We had 44 people looking at this. We had 19 Seeking Alpha analysts looking at this, and 12 of them said it's actually a buy. And their software is obviously doesn't look in that sort of thing. And as you can see, valuation is okay, C-, and then growth, profitability, and revisions. Basically, the growth is minus A, or so on. So yeah, you got a lot of information in there. So but let's go and look at the earnings and the estimates. Final thing, yeah, 50%, almost 30%, 31%, 40-something% is absolutely huge. 33%, 30%, almost 26%, 35%. So again, is one of those very, very high growth stocks out there. Next one is ASML. You might be surprised to think, what the hell is going on with ASML? ASML is basically still a high growth company. Okay, it has a wide economic moat, and I like the fact that they monopolize that market, that they own basically every single company that wants to produce their own chips. They go to them to get those giant machines that cost about £1 million or dollars, whatever. $635 per share is where it is. $19 PE. EPS, sorry, and PE is about 33, which is quite expensive for this company, because this is a mature company almost, right? Price to sales, PEG ratio of 1.41, that's not bad at all. Price to sales, we're looking about 9. Profit margin is 28%, return on equity 80%, current ratio above 1. $8 billion of basically free cash flow, which is quite nice. They have returned about 24% last 10 years. Next year, about 21% growth, and then 30%. 17% discounted right now. $760 per share is which the price should be. That's just according to Morningstar anyway. So let's have a look at in terms of what the company has done year to date. Not much. I mean, about 16% up since the beginning of the year. Okay, in the last 5 years, what have you done? 230 something. Okay, and then in the last 10 years, 720. So it's a very high growth company if you think about it. Forward PE, we're looking about 30, so that's kind of normal for this company. This is almost a buy, which is surprisingly good. And you've got another buy according to Seeking Alpha Analyst, and then you've got another buy as well. We've got 23 actually said it's a strong buy. Why is not that strong buy then? But yeah, so you've got that, and then you've got the prices about 20. So they're saying $825 is where the price should be. It's about 30% upside from where it is right now. In terms of earnings that going forward, this is interesting because it's there 30, 22, 27. You know, it's actually more in line with all the other companies that we've just seen. So in terms of revenue, it's not much. So $29 billion to 31 to 38 to 43 billion dollars. So there's a massive jump somewhere in there, and then 43, then in the it goes into the 50s, and then it goes into the 60s. But remember, these are like certain individuals that have decided to do this way ahead. But I'm only going to use the first 4 if you like. So by the 2026, okay, the earnings are still growing about 16% double digit, 15% double digit, which is quite nice. So there you have it. There's 5 basically different companies that I want to share with you guys. There you have it in terms of Sharia compliant. There's absolutely no issues. You can pause the video and have a look at that. But yeah, these are the type of businesses that you would want to own in your portfolio. But not massively, okay, maybe 5% of your overall portfolio if you like. I own ASML, this portfolio here, and I'm currently looking at these 2 here. So I've got a video plan coming up next couple of days, Palo Alto or CrowdStrike. I'm gonna buy one of these. I used to own CrowdStrike a lot, long time ago, sorry. But yeah, so I'm gonna look at these 2 companies or compare them and hopefully make a decision on which one I would actually add to this portfolio or the family portfolio, whichever goes. Okay, but there you have it. These are the type of businesses that you potentially might want to own it, but please do your own research and don't make 30, 40, 50% of your portfolio this type of business, because otherwise you're not going to have a good time. You will, when the stocks go down, your stocks will be going down 20-30%, but basically like in the entire portfolio will be down 20-30% every single day. Okay, so you have to make sure you have a balanced portfolio. Anyway, I'm going to stop right there. Have a wonderful day. Assalamu Alaikum.